What he's proposing to you is going to lead to financial disaster.
This guy who's this wealthy accountant doesn't even understand basic cash flow. Money and math are completely different.
The question is, what's the most efficient way to make that purchase?
The three most important words in personal finance that everybody needs to understand: compared to what?
Just because the numbers are better in one area than another doesn't mean it's the right decision for you. Hey everyone, this is Logan Hertz with Hazeltine LLC, and we are super excited to have with us the man, the myth, the legend, Chris Kirkpatrick of Life 180, coming to us from his new villa in the Dominican Republic, where he has several Ferraris, several Lamborghinis, servants, porters, butlers, but he's scaled down. He's only got 3 Lamborghinis now, only 3.
I traded all that in, man. I traded all in for horses and goats and cows and chickens and all the fun stuff.
Excellent. He's going organic.
We're going the organic
the
route.
agrarian nobility. The agrarian nobility is what we got, not the urban nobility. Okay. So we've been going through these objections to the infinite banking concept through this article from the Wealthy Accountant that was sent to me by a prospect. And Peter Nelson and I have started dissecting it. But I wanted to get Chris Kirkpatrick on here because, of course, Chris Kirkpatrick is the target, in a way, of this video. So he posts a video from Chris and kind of dissects it and explains why Chris is basically a moron, and you know, what he's proposing to you is going to lead to financial disaster. According to this guy, he's not just saying what you're proposing is suboptimal. He's saying it's going to ruin people's financial lives. So pretty much, Chris, you are like giving payday loans to people and taking advantage of them. So how dare you?
I'm a really horrible person, apparently. I'm
going to try as briefly as I can to reiterate what Peter and I went through, and then we'll let Chris pick up where we left off. So let me share my screen. We'll start going through this article by the Wealthy Accountant. Okay. So infinite banking concept without life insurance. Okay. So when people have, so I've already read through the article, but basically he's saying that infinite banking has some major flaws to it, major flaws. He's also claiming that insurance companies and their agents invented the infinite banking concept as a sales pitch for life insurance. Of course, it's not true. And what he says, Chris, is infinite banking is a twist on the sinking fund. You see? So infinite banking swaps out the bank deposit with the insurance company and uses a good story to convince you the insurance company has a better deal. Plus, you get life insurance. So this is one I've not heard before. Infinite banking is a twist on the sinking fund. That's interesting. At least he's not calling it an investment.
Right.
And then notice here, he says, to show that he's not biased, this is his way of showing he's not biased. He cherry picks one video from the internet and posts it. That's how he shows.
At least he cherry picked my video, so I can, you know, clap back at him. Because I always find it funny when people target me, because I'm the one dude that's not going to let you get away with it. Probably, like, if you come at me. Ask David McKnight. You come at me, I'm gonna like come back at you as hard as anybody. Like, my goal, if you come at me, is to make you realize you're either gonna debate me live on the topic where I'm gonna make you look foolish, or you're gonna shut up. Like, and I'm not gonna do it any other way. But it's Chris, so like, go ahead.
You don't need to make this guy look foolish. He does a plenty good job on this.
Okay, fair enough.
Yeah. You want to pick on someone your own size, Chris. So the promise of infinite banking is that a properly structured whole life insurance policy provides a safe place to save money so you can borrow from yourself at a future date to invest in income producing assets. That's not too far from the truth. I mean, there's some things wrong with it, but that's not too far off, right? So if the whole life insurance policy is structured properly, placed with an insurance company that pays interest even on funds you have borrowed out, you can double dip by borrowing from yourself to buy income producing assets, while at the same time still earning interest on the full value of the account in the whole life policy. This, in theory, supercharges your ability to grow wealth. Okay. Peter and I have dived deep into that. Cool. Now here's your screenshot, Chris. All right. So infinite banking versus the sinking fund. Okay. So it's interesting that he's comparing it to a sinking fund.
Well, yeah, I mean, that's like, so I'd never heard, honestly, the term sinking fund. I don't, that's not the world I live in. I don't operate my personal finances that way, and I don't coach to it, so I'd never heard it before. I just Googled it for all you viewers at home. If you've never heard of it either, basically a sinking fund is basically saying you're saving money for a future date, and then you spend that money. So you can see here you save, and that board and the image on the screen right now is basically saying you're saving money every single year. The example I was using was buying a car. You save for 5 years and then you pay cash for the car. So you save up and then boom, you sink the deposits basically all the way down to zero. You pay for that vehicle. And then when you do that, you now are left with a decision where you have no more money, and you've avoided having a car payment. But if you know you have to have a car payment, you have to have a vehicle. This is why I like to use a car as an example, because we all need vehicles. Every 5 to 7 years, people get new vehicles kind of on the outside. And so if you know that's the case and you know you're going to need to buy a new vehicle, well, you know, maybe you avoided the car payment, you maybe avoided interest, but you also, there's an opportunity cost with paying the cash because you lose the ability to earn money with that cash. And you know you're going to have to save more money for your next car. Otherwise, you're going to drive a beater for the rest of your life, or you're going to have to finance a car in the future, right? So, you know, to me, and I'll let you continue, but to me, the problem that I have, and I don't even know, I haven't, full transparency, everybody, I haven't watched this video. I haven't watched his video, Hazeltine Financial Channel. I know you guys did a series of videos, and I haven't watched the videos, quite frankly. I watched like a couple minutes of the first one. I haven't even read this article yet. You sent it to me. I've been so busy, I haven't even had time to go through it. But what I can tell you is this guy who's this wealthy accountant, he doesn't even understand basic cash flow. Like he's in like that's the thing, because that's what this is all about. It's cash flow, and that's what we're talking about.
Right.
And so, you know,
I don't think
it,
he ever uses the word cash flow in
yeah, it's
his article.
yeah. So
So he's missing
I
the
would
point.
yeah. So I would just say that is like, you know, I don't know. His name is the wealthy accountant. Like,
Well, according to the article, he's going to say you don't understand the sinking fund, and he's going to explain.
oh,
So he's
okay.
saying you have a misunderstanding of how the sinking fund works.
Do I
And if
now?
you
Okay,
did
I can't wait to
understand
hear.
how it works, you would understand why it's superior to infinite banking. So let's let him share his
This is gonna be
argument with
fun.
you.
All right,
Okay.
fair enough.
So he says in a sinking fund, you save money to handle large future purchases. For example, you may save a monthly amount in a sinking fund to replace your car. You
Mm-hmm.
then buy the car with cash.
Mm-hmm.
The argument made in the video is that you never get anywhere with a sinking fund. You deplete the fund when you pay cash for the car and replenish the sinking fund only to the previous level. That is a massive misunderstanding of the sinking fund. The money in a sinking fund earns interest. When you use the money to pay cash for a car, what infinite banking calls borrowing from yourself, you pay the sinking fund back with interest. That is how you keep up with inflation. The sinking fund is always growing via interest from the saving account or from your car payments to your vehicle's sinking fund. It also happens to be what infinite banking conveniently forgets for the sinking fund and has excellent recall when applied to their life insurance product. Do you kind of understand his argument there?
No, I feel like he's talking in
Yeah, no, I'm
circles.
with you. He's not being very cogent. Is very confused. What my understanding of what he's saying is, you don't just deplete your sinking fund to zero, right? You keep making contributions, and it keeps earning interest, and you keep paying
Well, of
yourself back,
course.
similar to the way you would pay a policy loan back. Okay,
Yeah.
but of course, the difference, as you and I both know, is when you take money out of your sinking fund to buy the car, you're no longer earning on that money in your sinking fund. You
Right.
had to withdraw it.
Yeah, you've
Whereas when you
reset it.
use a policy loan from whole life insurance to go and buy the car, you're still earning on the full principal balance, right? So when he says your sinking fund is still growing, well, only if you keep making contributions, right?
Mm-hmm.
Whereas with whole life, we could, in theory, stop making contributions to the policy, and we
I
take
mean,
out
yeah,
a policy loan, and the full principal balance keeps earning, right?
yeah, totally. I mean, I would say depending on how old the policy is and so on and so forth. I mean, I'm not an advocate of taking policy loans and not managing the policy loans.
Mhm.
But that said, I mean, like what you just said is dead on. I mean, you got the sinking fund, you save money, you withdraw the money to pay cash for a car, and then you got to keep saving that money back up. And when you withdraw the money, if you were earning interest the entire time, this is the entire point of the infinite banking concept. If in a bank account, you're saving it up, and let's say you're earning in a high interest rate environment right now, 4.5%, then you take that money out, you are no longer earning 4.5% on that sinking fund. You've now put that money into the car, and the opportunity cost of paying for that car in cash is at bare minimum 4.5%, because now you have lost the ability to earn 4.5%. Let's say you spent $50,000 on that car. You've lost the ability for that $50,000 to be earning that 4.5%. And so now in a world, now let's take it a step back and we'll go, all right, if you bought this car 2-3 years ago and you were earning 4%, which wasn't the case because back then you were earning 1%, which even puts more
0.1%.
value in a life insurance. If you were lucky, you were earning 1%, which puts more value on what we're talking about with utilizing whole life insurance and infinite banking. But if you're interrupting that money, that's your cost. Now, if I could go get a car loan right now at 2%, why would I ever pay cash for a car where I know I could pay 2% but earn 4.5%, right? Like that just, and so what we're doing, you know, in the infinite banking concept, and I'm not going to get all like high level theory on it all, but just talking simple basic math here is like, if I could buy a car for 50 grand through a policy loan at 5.5%, I could show you mathematically how if I manage the cash flow to make savings for the future of that payment at 5.5%, which is simple interest, right? Which, by the way, simple interest does compound against you if you don't, manage it. But simple interest also works better for you in the sense that if you make monthly payments, that 5.5% annual number actually gets compressed and goes down when you make monthly payments, because simple interest is on the current balance due. So when you pay it down, the effective interest rate that you're going to pay over the time is going to be less. Meanwhile, if I could keep earning in an uninterrupted fashion 4.5% on that money, on that 50K, I could show you on a spreadsheet very cleanly, very simply, how earning 4.5% compounded versus paying 5.5% simple interest, I'm going to win with the compounding over time. That's it. I mean, it's not,
Right.
and so I always tell people money and math are completely different. And a lot of people like to use math to misguide people about how math works with money, right? And so what we need to do is we need to understand that there's different numbers, because not all averages, not all percentages or APRs, not all like rates are created equally, right? And there's so many different variables, so many different products, so many different ways things are calculated. And if you don't understand the back end of everything, well, then you're able to create, hack job hit pieces like this to misinform people. And, this guy, unfortunately for this guy, he's like coming at me trying to hit me. And all he's done is exposed himself as a neophyte who doesn't understand basic math and basic concepts about products that have existed for 180 years.
Right. I would make a distinction. See, I was a math major, and I would make a distinction between math and arithmetic. Okay. Once you get past multivariable calculus in college, there are no more numbers. We're never talking numbers. It's all proofs. It's all conceptual.
Yeah,
that's
true. That's true.
Because once you understand the concepts, you can write a software program to crunch the numbers. You don't need a human being for that. Okay. People get lost in the numbers, and the problem is not their numbers. Usually their numbers are internally consistent and they're fine. The problem is the assumptions behind the numbers, the philosophical framework they're working with, whether knowingly or unknowingly. So they're spitting out numbers that don't mean anything or are being misinterpreted. So to your point, they're saying, well, I'm earning 4.5% in the policy and I'm paying 5.5% interest on the loan. Why would I do that? I'm losing money. No, you're not understanding how mathematics works. You're just looking at two numbers, not understanding what those numbers mean. And of course, the question as always is, well, as compared to what? As compared to what? If you're going to buy a car, you're going to buy it anyway, right? So you have this expense anyway. The question is, what's the most efficient way to make that purchase? Okay. So if we can recover any of that money you were going to spend, you're coming out ahead, right?
Totally.
We're not talking about buying a cash flowing asset where you're expecting positive arbitrage and massive amounts of cash flow. We're talking about just a purchase you're going to make anyway. So as
Yep.
long as you're going to make that purchase, why don't you make it in such a way that you recover the opportunity cost of that money, right? No one's saying you're going to earn 12% on money when you're buying a car. Like that's ridiculous. Okay.
I want to take a step back and I want to re-say something you just said. The three most important words in personal finance that everybody needs to understand: compared to what? Okay? Compared to what? And if you all learn to ask yourself that question with every financial decision you ever make, as to just like what it is and why you're doing it and what your options are, your financial life will never be the same. Like you'll always just
Yep.
moving
Asking that
progressive.
question. Yep. So I used to be someone who hated debt, never got into debt, paid cash, everything. And that's a good place to be, by the way. Like if you are that person, you are great. You are a great candidate for this because you have financial discipline. That's great.
Yep.
Once I had the experience of having a mortgage, I started to understand, as compared to what? Okay, I could pay off this mortgage and not pay that interest, but also if I deploy that money and earn on it, maybe I could have a better outcome, right? And so I started to get more comfortable with the idea of using debt responsibly, strategically, right?
Yeah.
That maybe the best thing to do in all scenarios is not necessarily pay cash for everything. Maybe there are other options, right? And of course, as you and I talk about, there's a huge psychological component to this as well. So getting back to the point that money are not the same, just because the numbers are better in one area than another doesn't mean it's the right decision for you. So I know someone who's done very well. The only debt he ever had was his first mortgage. Since then, he's paid cash for everything. He does everything with cash. For him, I mean, I'm sure I can mathematically show him how, hey, if you use debt, you'd get ahead. But that's not the right decision for him. That's not his psychological makeup. He's not comfortable with it. It would be wrong for him to try and use debt, right? So just because the numbers look better in one scenario versus another doesn't mean it's better. There are other intangible elements to infinite banking, like control, having control over the banking function. So anyway, yeah. All right. So we'll jump back into this.
All right, go back.
And, he's going to get into some numbers.
Can't wait.
But the numbers, and of course, the problem is not the numbers. His numbers are fine. The problem is the assumptions behind the numbers. Right? I know this is going to shock you, but he's about to get into rate of return as if that were the metric. This is what everyone myopically focuses on, right? What's my rate of return? Oh boy, here we go. Here we go. Chris, the last time you bought a car, what was your return on investment? Let me ask you that.
Yeah, exactly. Well, I'm trying to sell my Jeep right now, still 3 months into moving to the Dominican Republic, and the market in the United States for car resales has gone through the floor. I wish I had taken $37,000 a year ago when, a dealership offered it to me. But, alas, here we are.
But you were too focused on the numbers, Chris. You said you can get a better number elsewhere, right?
No, I was too busy focused on the emotion behind keeping my Jeep.
Yeah. No, we all need to admit, I'd still do it. We are emotional people. We make emotional decisions. And the more we can just be brutally honest with ourselves about that, the better we can manage it, rather than pretending like we're Superman.
Totally.
No, we're not.
Totally.
So, Chris, tell me if this sounds like a qualified financial professional analysis. Infinite banking's rate of return sucks.
Ha!
Does that sound like, a professional who's giving you, objective analysis?
I mean, I don't know. It's hard for me to be critical about that because I tell plenty of other people that their stuff sucks. So, like I'll tell him his plan sucks, like that's fine. Like, but let's have a debate. Like the difference is like if I'm willing to say somebody's stuff sucks, I'm willing to get on and have a conversation with them,
right,
and give them an opportunity to debate
respond.
about it live,
Yeah. Okay, so what is that old saying? Figures don't lie, but liars figure. Well, I'm not calling anyone a liar. That's how you know he is calling you a liar, by the way.
Yeah, I feel like he called me a liar there.
Yeah. He loves to insinuate something without actually saying it, right? It's sort of like the humble brag.
Okay. I have thick skin. I'll be
the words coming out of my mouth are kind of the opposite of what I'm really saying. That way I can get with it and pretend I never said it. I insinuated it, right?
Yeah. Let me pretend to take the high road.
I am calling the math into question, however. In the video, we hear our first excited brag. See the 22,097 highlighted? That, we are told, is the increase in our cash value in year 2. But let's dig a bit here. The real brag should be that you contributed $220,000 to the infinite banking policy and still only have a cash value of $207,000, a loss of $12,000 up to this point. But the $22,000 comes from the non-guaranteed columns. The guaranteed amount is less, and you still have a loss regardless of what column of the projection you use. So Chris, you want to address this? You lost. You're telling people this is a great investment, and yet you
Listen,
lost $22,000.
first of all, I've never told anybody that this is a great investment. I would never use whole life insurance and the word investment in the same sentence, in the same paragraph. Like maybe I would say use your whole life insurance policy to borrow against, to invest in something else. I say that all the time. But the policy itself is not an investment. It's a banking alternative. It's a better place to keep your safe, liquid, accessible capital for opportunity and for emergencies. The problem with a guy like this is he just, you called it, you nailed it. He's just looking at the numbers, right? If you look at any of this, he's not wrong, right? Like, so yeah, you're 12,000 behind the 8 ball. And you've put in 220.
Wait, don't, Chris, don't give him too much credit.
No, but like, listen. I'm gonna try to be nice, right? Like, so he's 12. I'm 12,000 behind you. Put in 220, you got 208 roughly, right? Like 207 and change. And so like, we just said it compared to what? Like, what are my options? Okay, so the thing I love about this policy, and I'll go to my grave saying that this is the best thing to do if you have the ability to think long term. What this guy does by pointing out these numbers tells me he has absolutely no vision for life and no vision for what he needs in the future and from a long-term perspective. This illustration is of a 40-year-old ending at 41 at the end of year 1. And so it's fair to say that this person probably has kids. Fair to say they probably are going to live a long life, and that if they're like most people, they're going to get to retirement. They're going to have different needs in retirement for different, cash flow elements to meet their retirement needs. They're maybe going to need like long-term care. They're going to maybe need, cash to help protect them in that instance. And so the question becomes, like, even if we get out of all the other philosophy and just talk, what is this policy doing? Well, the policy is getting you in this number. I got to get close because it's really small. Let's just call it almost $3 million of life insurance. $3 million of life insurance right there, right? So we're at $3 million of life insurance. So out of that $12,000, that, by the way, you didn't lose, you just lost access to it for a short period of time because you're investing in a concept. You're investing, the policy is not an investment, but you are inherently investing in your future well-being by using a financial strategy that is going to guarantee a specific result. Now, if the specific desired result is not, I want my money in a place that long-term is going to outperform a bank, that's going to compare to bond-like returns from a long-term perspective, muni bond-like tax treatment, and money market-like liquidity, like savings alternative. If that's not appealing to you, okay, well then how about the death benefit? You're going to get that death benefit. You can see by the time year 10 rolls around, which notice he doesn't go that far down the board, the person has put in 380,000. Go around that with your cursor right there real quick because I don't have a cursor to go over it. 380,000 in cumulative premium. They got 436,000 of net cash value. Okay? I don't know where you're going to find that from a long-term perspective in a savings account. Now, right now at 4.5%, you could probably get really close, probably beat that a little bit, and that's fine, but you're still not going to have the $3.3 million of death benefit. So that said, now he's going to say, and I'm jumping ahead, but bear with me because I just want to knock all this out while my head's on it. He's going to say, you don't keep the cash value because you have that $436,000. The life insurance company is going to keep that $436,000. Well, keep in mind, when you first started this policy, that $2.965 million of death benefit, knock $185,000 off that because that's a lot of paid up additions that went into it. You really got about 1.8 million-ish or 2.8 million in death benefits, right?
Mhm.
And so with that 2.8 million, what happens is as the cash value grows, therefore, so does the death benefit, because you're utilizing what's called paid up additions, which is short for saying paid up additional permanent life insurance, whole life insurance. So as you buy those and as the cash value goes up and is operating super efficient from a liquidity perspective, your death benefit is increasing with it. Now, the option is I could put that money in a savings account. So if I died at year 10, I could have $436,000 and no life insurance, right? Or maybe
Mhm.
I buy a term. Let's say I bought term at whatever. He's going to say buy term and invest the difference because he's too simple to understand this. So he's going to say go buy term. If you did that, let's say I bought $3.3 million, right? Or 2.9 million, let's call it, instead of the 3.3. What's going to happen is that money, that $436,000 in a savings account, would be taxable to the heirs in a lot of situations, right? In this situation, because it's here, they basically could segment it and say, I'm going to give you the 2.9 million and you're going to keep the 436 and we're going to tax the 436 and the 2.9 is going to be tax free. But no, they don't. They give it to you all in a death benefit and they keep the cash value and you get the taxable advantage for that. So I love how this is like one of the areas that almost everybody complains and says it's a ripoff when it's one of the greatest value adds to the entire concept.
It is.
And
Mhm.
it's mind-blowing. People like him like only look at the first couple of years. Well, now let's talk about that. Let's go back to like the fact that we're $12,000 short on what we've contributed in year 2. Well, once again, what are we doing from a long-term perspective? We're talking by year 5, you can look there, we put in 280, we got 281,000. Now, I'm also going to say, he says it's non-guaranteed. Well, he probably doesn't even know what makes up the calculation for non-guaranteed assumption. The non-guaranteed assumption means that we're utilizing that the concept, or we're assuming that the life insurance paid a dividend that year, right? And he said, and by the way, dividends are not guaranteed, but any of the companies that we use have paid a dividend every single year for at least 110 years. That's kind of our rule. 110 years consecutive, never missing it, even during the Great Depression, the recession, all the wars, everything, right? So it's as bad as guaranteed that you're going to find in the world for not being guaranteed, right?
Yeah, show
And
me
then,
show me the guaranteed side of the ledger when you put your money in a savings account or anything. Show me the guaranteed side of the ledger,
yeah,
please.
not only that, like think about it, anything in a bank account, anything over 250 is not going to have any guarantee without FDIC. And we could have a whole tangent about the joke of the FDIC, right? And so, but here's the deal. When we look at this, you're ahead starting in year 5. And so the question is, can you give up? Would you be willing to give up? If I asked you a question, and this is the thing, let's not talk numbers. Let's use common sense and let's help people solve problems, right? So if I were to talk to you and say, hey, are you willing to give up, Logan? Are you willing to give up 8% liquidity, 7.5% liquidity of your money over the first year, and maybe 5% liquidity the second year of the money, which, if you do that, but would you be willing to give it up if it's going to give you this big death benefit, if it's going to give you better returns in your bank from long-term perspective, if it's going to give you living benefits while you're alive? So by the way, if you become critically, chronically, or terminally ill while you're in retirement or anytime during life, as long as the contract is there and you're paying your premium, and you're following this, would you be willing to give up that short liquidity crunch? Would you be willing to just give up 5 to 7% from a short-term perspective, as long as you're back to even year 5 and you get better and better and better thereafter, and it's going to outperform, it's going to be like a bank account on steroids after that. It's going to be like nothing else in the world at that point in time. Would you be willing to give that up if it's going to solve all these other problems for you? And most people, and I do this every day, so I know the answer, almost everybody says, heck yeah, because it's not a matter. This is a situation where you were just talking about the math doesn't matter, but also the assumptions matter, right? He's assuming, he's like, it's non-guaranteed. Stop being a fearmonger, scare tactic, dude, right? Like all you're talking about when you say it's non-guaranteed, you probably don't even know how the guaranteed is calculated. It's guaranteed.
Right.
Like if you were talking to me, and in fairness, I'm going to give him a little credit, okay? And this is the reason why whole life insurance has a bad reputation, is because people like this guy, I don't know how old he is, but Dave Ramsey and Art Williams and all the people that, and Susie Orman, that all the people that love to hate on whole life insurance, love to hate on it because of the fact that, if I sold you this policy with a non-guaranteed assumption in 1985 when dividend rates were at 13%, right? And everybody was assuming that, well, yeah, because the dividend scale assumption here is 100, that a dividend is going to be paid, and it's paid at 100% of the current dividend scale, which in 1985, if it was higher, and then it got worse and worse and worse over the next 3 decades, yeah, it's going to underperform. And your expectations, if you didn't understand what you were buying, would not have been in alignment. However, right now, in today's environment, dividend rates are at the lowest they've been in 80 years, right? They're going to get paid every year. I would make a real strong argument to anybody that this policy is actually going to outperform what you're looking at. Right. Because of the fact that if you think the fixed interest rate environment is going up and it is going to remain kind of in the environment where we are right now, where the Fed funds rate is in the 5.5%, and you don't think they're going to bring the Fed funds rate back below 3, right? Then what we're looking at is this market, this policy is going to outperform this because the dividend scale is going to increase off of their 80-year lows, and it's going to get better and better, and this policy is going to perform better, And is that a guarantee? No, but like anything else, the question is compared to what? And the question is, do you understand what you're putting your money into, right? And it irritates the crap out of me when I see people like this do these. Like, if you're going to do a hit job, like do a hit job, like do your research and understand what you're actually talking about.
Right. And to your point, people just get so focused on the numbers on the page. And this is why people will put their money into pretty terrible vehicles, because those numbers have way more aggressive and unrealistic assumptions behind them. Right. Sorry. So, but they just see, wow, look at these numbers on the page. Yeah. I remember an agency was trying to recruit me into some of the things that they were doing. You're probably familiar with this agency. I'll leave names out of it, but they're showing me this spreadsheet with all these great numbers and the stuff they're doing. It involved whole life, and then using policy loans from whole life to invest in other things. And I'm like, okay, yeah, these numbers look amazing. And then I started asking, can I see like what's behind it, blah, blah. And it was like nobody had ever asked that question before. Mm-hmm. They sold it like crazy because people just saw the numbers on the spreadsheet. They're like, wow, this is amazing. Sign me up. It's like nobody had even asked the question, wait a minute, where did these numbers come from? You're just assuming you're going to get this great rate of return on the investment. So you take out a policy loan, then you invest in this great thing and you get this great return. Well, wait a minute. I need to know where that return is coming from. Like, how safe is it? How guaranteed is it? Right. Crazy, but people just see the numbers and like, wow, this is amazing. And so I think we're kind of, in a good way, we're hurt by the fact that we make much more conservative, realistic assumptions when we're putting our numbers together. So of course they don't look as good. We're not assuming you're getting 12% returns from here till hereafter, right? Yeah. We wouldn't do that. But of course the numbers are going to look better if you put your money in mutual funds and they're allowed to just assume you're going to get 12%. I mean, that's not an argument. That's just an assumption, right? Sure. Yeah. You got to understand the assumptions behind the numbers, because behind every number is an assumption. Mm-hmm. Okay. When we're trying to predict the future, we got to make assumptions. Okay. Infinite banking's rate of return sucks, part 2. Okay. Oh, wait a minute. This is not an investment, so why are we talking about rate of return?
Yeah, I mean, like once again, we're not comparing this to an investment. We're comparing this to a bank. A bank. Like, that's what we're talking about, guys. Like, anybody that is going to compare this to an investment is just doesn't understand what they're even comparing it to in the first place,
Right. Okay, now we turn to the longer term rate of return with infinite banking. Before we reveal the true long-term rate of return, the whole life policy projection of a promoter of infinite banking, let's ponder the idea of tying so much money up in what the video just described as a savings account. The whole, pun intended, premise of infinite banking is to have an ever-growing pile of money in a low-yield savings account. The only way to turn this into a win is to use faulty math. But first, review the future value calculation below.
Nice.
Yeah, here's why I love these numbers people, right? Look how scientific he's being, Chris. Look, this guy's amazing. He's tearing us apart. I mean, he's really just, he's got all this science and numbers, and we're just, man, wow, look at
Uh-huh.
this.
Uh-huh.
So what he's doing is he's saying, Chris, 10 years, right? So let me back up.
Mm-hmm.
What he's doing is he's saying, look at the numbers 10 years from now, right? You've put in
Mm-hmm.
400,000 in premiums and you have
Mm-hmm.
472,000 in terms of cash value. So
Sure.
what would that equate to in terms of a rate of return? Well, it comes to a little over 2%,
Sure.
right?
Yep.
Annually. True.
Yep.
True. Your numbers are correct. There's nothing wrong
Mm,
with your numbers,
yeah.
right? So
No
there you show.
problem.
Okay. So great. You got this nice chart and all these numbers show how scientific
Uh-huh.
you are. And I'm not
Yep.
disputing your numbers.
Not
Neither
at
Chris
all.
nor I are disputing your numbers. That is correct. That equates to a 2.15% rate of return. Okay. Now let me ask you a question, Chris.
Sure.
Let's say you have money you're going to spend anyway, and you're going to pay cash.
Mm-hmm.
And I say, Chris, instead of paying cash, why don't you use this credit card that gives you 2% back? So take that. Let's say you're going to spend $400,000 over the next 10 years.
Yep.
And I'm showing you, well, okay, fine, but use this rewards earning credit card to do it instead. So now you're going to get 2% back, right? Is that something you think would be a smart thing to do instead of paying cash?